all of you here today. My name is Eric Stokin. I'm the director of the Center for Social Science Scholarship and an associate professor of political science. We at CS3 are very glad to be co-hosting in coordination with the Department of Political Science, Dr. Ian Anson, for this talk titled When an Elephant Meets a Bear, How Stock Markets Shape Americans' Public Attitudes. Before I introduce Dr. Anson and the talk, I thought you might be interested in an upcoming event, which is happening tomorrow at 4 p.m. in the library gallery. The history department will host their annual Low Lecture, and that's part of the Social Science Forum. Amber Mitchell is the curator of Black History at the Henry Ford Museum of American Innovation, and she'll discuss, for generations yet unborn, observations and challenges in Black public history. You can find out details on these events and much more at socialscience.umbc.edu. CS3 is also on LinkedIn, Blue Sky, and other social media sites at UMBC, SOC, SCI. And be sure to follow our My UMBC group. Particularly, be sure to follow our CS3 podcast, Retrieving the Social Sciences, hosted by our very own Dr. Ian Anson. And you can find this on Spotify, Apple, Amazon Music. So I'm really excited for the talk today. Dr. Anson's new book, Following the Ticker, which I highly recommend, and for which 5 of you will win a free copy, thanks to, in part, the Department of Political Science and CS3. It makes the case that Americans are increasingly looking to the stock market as one of the prime indicators of the economy, despite its faults as such a measure as a proxy for the broader economy. Dr. Anson shows that changes in this market can have major implications for politicians who, let's hypothetically say, enact sweeping tariffs to the detriment of the market. So to describe this and much more, please allow me to briefly introduce Dr. Ian Anson. Dr. Anson is an associate professor in the Department of Political Science at UMBC. He arrived at UMBC in 2015 after matriculating from Indiana University in Bloomington, Indiana. He holds a PhD in political science and a Master's of Science in Applied Statistics. Dr. Anson's primary scholarly interests lie at the intersection of the fields of public opinion, political communication, and political behavior. His work often focuses on partisan biases, motivated reasoning, and factual misperceptions in American public opinion. Dr. Anson also contributes to the scholarship of teaching and learning. His recent book, entitled Following the Ticker, The Political Origins and Consequences of American Stock Market Perceptions, examines how public opinion and political behavior have reshaped since the 1980s by media attention to the stock market. So without further ado, let me turn it over to Dr. Anson.
All right. Well, thank you very much, Eric, and thank you, Amy, so much for helping to facilitate this event. Thanks to Brian Grodsky, the Department of Political Science, also for co-sponsoring. I'm really delighted to be here today to talk to you about this subject. It's interesting that it is a subject that I think has perennial implications, but at certain moments of volatility, people start to ask me a little bit more about it. And so I'm glad to be here. I'm very grateful for the opportunity. It also is sort of ironic and unfortunate that I tend to get to talk about this book when things are looking shakier and more volatile. So with that irony in mind, hopefully this will add to your knowledge, your understanding of the subject as we all sort of look towards some economic storm clouds on the horizon. So this topic is, or the title that is, of this talk is called When an Elephant Meets a Bear. And I told this to my wife and she was like, what are you talking about? Why are you talking about these animals? For those of you who aren't immediately keen to the title, I wanted to, first of all, sort of set the stage for why I'm talking about this book today. So the first is the elephants, the elephant in the room, so to speak. Also elephants, of course, are historically associated with the GOP. So President Trump being the Republican president of the moment. This is a graph from Real Clear Polling, which aggregates job approval ratings of President Trump over the just about the entire span of his presidency. the second presidency, that is. And you can see ultimately that this red line here is percent in these surveys voicing disapproval, and the black line is the percent voicing approval. And you can see that, this is a pattern that many presidents see in their first few months of office. We see sort of a honeymoon phase where the positives generally outweigh the negatives in terms of job approval, but then there's ultimately a fall off. However, I would draw your attention to the second half of this graph where that fall off has become especially steep among approval. So approval rating of Trump is now down and continues to fall somewhere in the range of 46, 47%, which historically is not very good for sitting presidents at this time in office. And so obviously there's a lot going on in the world right now, a lot of reasons for us to try to understand the change in Trump's job approval rating since he took office. But one story that certainly many people are thinking about right now is not about the elephant, but about the potential for a bear. And so a bear, in this sense, I'm talking about a bear market, right? We often talk about the stock market in terms of bulls, that is, people who have more positive appraisals of the future of the market, and bears, those who are betting on the market essentially losing value over time. I just grabbed this yesterday off of kind of just the Google market summary of the S&P 500, which is a standard way of understanding kind of in broad strokes the market as a whole. We can see essentially that as of yesterday, basically the market's lost somewhere around 8.5% of its value since over the last 6 months. So it doesn't let me start in January, but you can sort of cut this graph in half and you can sort of see the trajectory. A lot of people have been talking about this. I think that it is not hard to imagine that this has been at the forefront of many people in the audience's minds at the present moment. Many people have been advised not to check their 401ks recently. Just don't look, because it's a little bit dicey. People have, on average, lost several $1,000s in their retirement savings. And so depending on how close people are to retirement, that could mean some amount of economic pain or potentially more economic pain. And so the question that I take up in my research and the question that I continue to probe is essentially whether there's a connection between these series, right? Does the elephant suffer from its interaction with the bear? And if so, what does that portend for elections in the future, for the president's capacity to craft policy, for the political dynamics that go beyond the ballot box and speak to a variety of different sort of social movement based and interest group based actions that might shape Americans' political fortunes in the future. And so this connection, a connection that maybe at first glance seems obvious to some, really speaks to a broader and more historical literature in political science that has been met with a challenge in recent times. And so if you know kind of one thing about voting behavior, having taken a course, maybe an undergraduate, or maybe having spoken to a political scientist in the past, one of the most foundational sort of relationships in political science is this idea that if an incumbent president presides over a crappy economy, they tend to lose. We can look at many historical examples in the past of bad economies punishing incumbents. There's Jimmy Carter, presiding over a difficult economy and ultimately being a one-term president. There's the 2008, the Republicans being punished at the ballot box in part in the conditions of the Great Recession. There's even the argument that could be made that the volatility of the COVID era was also damaging to Trump's prospects in the 2020 election as well. So bad economies hurt incumbents. And the reason for this is that Americans are very sensitive to changing national conditions. There's been a longstanding argument, debate, discussion in the literature over whether it's really about things that voters perceive out there in the world about things in the national economy, things that are happening to the economy as a whole, or whether people are feeling those changes to the economy in their pocketbooks. And that debate continues, but I would sort of summarize that literature by saying that it's a little bit of column A, it's a little bit of column B, but Americans fundamentally can't understand really what's happening in the world around them without a mediated account of the national economy. And they are still, despite obviously their pocketbooks weighing to some extent on their minds at the ballot box, very sensitive to changes that are reported to them in news media about economic conditions. Nevertheless, and this is the challenge or the sort of confounding aspect of this literature, is that despite the overall pattern that we've witnessed over long periods of time, tying incumbents' fortunes to bad economies, we also have witnessed in the last 20, 30 years, the rise of very antagonistic partisanship and partisan identities in America that might render Americans' beliefs about the economy to be essentially hopelessly biased. That is to say, if you are a supporter of President Trump, you might think that the economy is much better than you would otherwise. And if you are a detractor or a proponent of the Democrats in the present moment, you might be more pessimistic than you would otherwise be about the economy. And that is in part due to the psychological process of motivated reasoning, which means that partisans essentially have emotional stakes in their beliefs about the present and the future, and they filter what they hear and learn about new developments through this social identity lens to make themselves feel good. So partisans are trying as much as possible to serve this need for self-esteem, and their self-esteem being so tied to their partisan identity means that they reject information that causes the party to look bad, they accept information that causes the party to look good to them, and this means that Republicans and Democrats' beliefs about that economy tend to divide really intensely, even when economic conditions are very plain for people to see. So there's a tension in this literature, and I would argue, and I argue in the book, that one of the ways to resolve this tension is to look more deeply into what we mean when we talk about the economy. And so in the book and in the rest of the talk, I'm going to be talking about the stock market as a very peculiar, a very specific kind of economic indicator that I would argue has increasing relevance to Americans' political behavior in recent times. And that is ultimately because, and I'll preview a lot of what I'm going to say next in some brief words here. It is because the stock market is notoriously ubiquitous in news media coverage of the economy. That is to say that more so than pretty much any other economic indicator, for reasons I will discuss, the news media saturates Americans' minds with knowledge of the stock market, meaning that even Americans that have very little interest, and by that I'm not talking about this from the economic sense, they don't have very much sort of desire to engage with the stock market. They still have a lot of passive knowledge of what the stock market is doing. Even those who do not have investments in the stock market tend to know a lot about the stock market. And consciously or unconsciously, many Americans are then, over time, becoming more willing to apply what they've learned to their judgments of incumbents. Of course, as I just said, this does not mean that partisans' judgments are not reliably biased. Even when we think about people's perceptions and attitudes towards the stock market, we know that Americans who are of the same party as the incumbent are going to be more positive. People who are of the opposite party of the incumbent are going to be reliably more negative. But, and this is an important, I think, argument that sort of ties together these considerations, stock market perceptions, with the addition of another perception that I'll talk about in a moment, relative to many other ways that we can think about the economy. These perceptions are much more accurate, if in a partisan sense, than these other judgments. People seem to express more reliable views about the stock market relative to ideas about the economy as a whole, or unemployment, or GDP growth, or wages, or any of these other topics, in part because of the saturation of information that they've received. And so this means that the stock market knowledge, if it does sort of fall into people's heads, intentionally or unintentionally, it comes to sort of pierce through a partisan layer to potentially render a more objective and therefore more critical determinant of vote choice in the electorate. So basically, even biased partisans are still going to be affected on the margin in their judgments of incumbents by the stock market and not by some of these other economic series that we've looked at in the past. So all that taken together means that if the stock market is what people are looking towards, if the stock market is ultimately rendering more accurate and therefore less hopelessly biased judgments for partisans, the last layer of this, and one that I'll get into at the end, is that attributions of responsibility, that is people's beliefs about who is responsible for making the stock market move, are therefore going to become the last sort of line of defense in determining whether co-partisans of the incumbent president might eventually turn against the president and stop supporting that president as on the basis of stock market prices. So this is a complicated set of stylized facts, I recognize, but I'm going to sort of talk through some of the evidence that I have to support them, and hopefully in that way make some of those things more clear. But before I do that, I want to make a couple of statements about the stock market itself. And so maybe some of you have seen this movie that's about the sort of GameStop stock debacle of the COVID era, when GameStop's stock price rose by an astronomical amount in a very short amount of time. This is memorialized in this movie with Paul Deneau here. And this was a real event that happened very recently. This is speaking to the increased interest in Americans, by Americans in the stock market, especially the rise of so-called retail investors, or basically casual investors who are picking stocks out there online. I would argue that this is kind of a dangerous way to do this. Very few casual retail investors are going to end up winners on the stock market, the GameStop people aside. But ultimately, this speaks to the renewed or continued relevance of the stock market in people's minds right now as a kind of gambling that many folks are engaging in on platforms like Robinhood right now. But beyond that, that's kind of one almost marginal example of why the stock market should matter to Americans' perceptions. It's a leading indicator of other aspects of the economy, right? When the stock market crashes, bad things usually follow in the labor market and other places. Also, Americans are much more engaged in the stock market than they were in the past, in part because of the erosion of pension systems, especially corporate pension systems, that mean that 401k plans, 403b plans, other kinds of retirement vehicles are largely, on the market, either in the form of index stocks or mutual funds. So a lot of Americans are watching these market indicators because their retirements are riding on them, whereas in the past, they might have relied more on pension programs. I mentioned retail investing. Finance is also a very large industry in America, so it's increasingly likely that people are going to work in the finance industry as a share of the overall workforce. And then also, just as an aside, right, 529 plans are increasingly popular for people who are helping their children save for college as well. So a lot of Americans have some stakes in the market. And so therefore, it is a relevant indicator for at least some people as they're looking to understand how the rising and falling of those prices might influence their personal pocketbooks. However, I would argue that Americans should also not care about the stock market perhaps as much as they do. I've got Kai Risdall on here. He's the longstanding lead of the Marketplace, NPR Marketplace program. And he is very famous for saying over and over again to his listeners, the stock market is not the economy. I think this is a very strong and important argument that needs to be made in order for us to understand the broader political context of Americans' increasing reliance on the stock market as a political judgment indicator. So for one thing, the stock market is not an investment vehicle for everyone in America, right? Only about 6 in 10 Americans have any investments in the stock market at all. And as we might imagine with a statistic like this, there's a very, very heavy bias towards the economic top. Most Americans have fairly little invested in the stock market, if they do have anything invested at all. The median portfolio, which is almost entirely retirement assets, is about $52,000, which I hate to be the bearer of bad news for those who are watching the talk and maybe have about $52,000 invested and are looking forward to a nice cushy retirement. That's probably not going to be enough, especially given people's extended life expectancies in this next generation. So essentially, we have this very long tail of people with a little bit of stocks, and then a few people at the very top with almost all of the shares of stocks. Stock market performance also is not a good indicator or a perfectly accurate indicator of other aspects of the economy as well, which means that it's also a curious indicator to be something that is increasingly important for people's economic judgments. For example, in the book, I would argue that Americans should be much more attuned to household wealth, median household wealth, and median wage growth as a way to understand economic well-being in the nation. However, it's a story that's told much less frequently in news media for reasons I'll discuss in just a moment. And I'll also show a couple of sort of series from the New York Fed to show that this is also a story that's about income and asset stratification across race and class. So, for example, since COVID, right, we've seen that real financial assets, right, there's a large stratification in real financial assets across racial categorizations in America, while real estate assets are relatively similar, suggesting that while in the past, right, the housing market used to be something that was a source of extreme stratification, it's really who owns basically stocks and retirement assets on the market that's an even bigger source of stratification, or becoming an even bigger source of stratification in America today. So the stock market is not the economy. It's also not telling some stories about who owns stocks across racial and other demographic lines. Interestingly, equities and mutual funds represented by this gray bar. Basically, white Americans have a lot more of those as a share of all of their financial assets relative to other kinds of assets. So equities and mutual funds here for white Americans represents something about 30%, 40% of the total of those assets. Black and Hispanic Americans are still, to some extent, more reliant on pension programs relative to stock ownership. So when the ticker moves, is my broad argument, it's not moving for everyone. It's moving for some people a lot more than it is for others. So again, I want to return to this question about why, right? If we don't think necessarily that the stock market is a perfect way to understand the economy, it's not a perfect and representative indicator of people's real material well-being on average in America, why are we so attuned to it? And my argument in the book and my argument here is about the role of news values in helping to drive saturation of stock market information for the public. And so news values we can theorize as either guidelines that are formally produced by news organizations or by some sort of journalistic organization, right, a code of conduct, or some set of unspoken assumptions that journalists have embedded in their work that are used to determine what is news and what is newsworthy. And so these news values have very particular, I think, expression in the realm of economic news. Economic news often follows a pattern that we might call an indicator story. An indicator story is a very standard way of describing an economic development. And if you've read one economic news story in a newspaper, you've read something like them all, because they tend to be extremely similar in the way that they are presented. They often focus on a development in a specific economic statistic. So an economic statistic is updated, there's a data release that happens, and individuals in the news media harness that data release, they download it from somewhere, they then write about what it means. They might often get some pull quotes from a couple of economic analysts, and then they'll conclude with a little rundown often of other market news or other news that is relevant to that indicator. And so they get the data, they describe the development, they talk about the implications in a short, kind of digestible format. But I would argue that these indicator stories often focus on stock markets relative to other economic indicators, in part because the stock market is providing data on a continuous basis, whereas other forms of economic information are provided on much less frequent intervals. So, for example, if we look at labor statistics, these are pretty relevant to people's lived experiences in America. However, right, we are reliant largely on government sources to do the very difficult, labor-intensive, no pun intended, process of conducting surveys, analyzing the data, making sure that it's really representative and accurate, and then publishing those releases largely on a monthly or a quarterly basis. So we don't learn about the labor market day by day relative to the stock market, which we can learn about instantaneously. Similarly, credit, housing, other kinds of indicators, right? We've got all these are all different data series that journalists look to help inform audiences of their understanding of the economy. So like the Census Bureau's housing starts data, right? It's only coming out once a month. And so journalists develop a calendar of when these releases happen, and they focus on them and then publish stories soon after they come out. Prices and wages, actually. Interestingly, there's a story in this talk that I want to get to about eggs. I know people are thinking about the price of eggs a lot these days. It's interesting that the price of eggs is something that we might learn about more quickly, actually, than the overall inflation numbers. And part of that is because we rely on the BLS to publish the CPI monthly. Whereas the price of eggs, we might be able to look at the egg market and find out information about eggs a little more rapidly than otherwise. So again, the sort of core argument here about why the news media would report the stock market so much is not so much because they believe that there's a strong audience demand for it, although I would argue that demand is growing. It's more about just doing the job, right? These data releases are more difficult to continue to talk about over an entire month, compared to the stock market, where we can follow the ticker quite literally day by day, and every day have something new to say about the movement of all of these different stocks and their prices. So covering the stock market makes sense for journalists who are trying to get the job done, right? Who are under deadline pressure, who have this need to fill this chasm of a news hole in a 24-hour news environment. There's also some other news values that might explain why it's so flashy for journalists to jump onto, right? One is that it's volatile. So if unemployment changes by 0.1% month over month, it doesn't feel like much of a story, right? Whereas if stock prices jump, 8% or whatever in a day, I mean, that's something that's very flashy. That movement of the line is something that journalists can chase. It's also very dramatic because we've got imagery, right? We've got all kinds of different actors who are associated with the stock market. These brokers, for example, who are down there. This is an anachronistic picture, right, of people down in the pit from an earlier era. But we've got endless amounts of reactions and people who are giving you that emotive kind of feedback to the market at all times. And there's exemplification where individual people can say, "Oh, I was screwed by this movement," or something like that. And then finally, right, journalists themselves might be more invested in the market than the average American, meaning that they themselves and maybe the editors might place a higher value on the stock market than if they were to understand their audience's demand for economic news. So I analyzed a variety of different news sources for the book to test this claim of essentially whether stock market news is more saturated or ubiquitous than otherwise. And so I'll show you a couple of graphics just from the book in terms of this content classification of indicator stories. One of these is the New York Times coverage from 1980 to 2020, about 5,000 indicator stories. What I did was I created a specialized lexicon of terms that describe these various indicators. This were, the hundreds of words and phrases that speak to these different indicators, with the help of a couple of very highly trained, advanced UMBC undergraduates to perform a lot of the clearing work to make this case. Ultimately, I ran this through a series of different automated content analytical frameworks and came up with these kinds of distributions. These are just examples here. We can look across a wide variety of different news sources. We can apply this very broadly and see more or less the same kind of distribution, where basically stock market news or news about the stock market tends to prevail in the distribution of indicator stories across a variety of different networks and places. MSNBC stands out as an interesting counterexample. MSNBC, the stock market, is not talked about quite as much. I spend a lot of time in the book talking about selective exposure and about differences here. But it may be that there's some partisan agenda setting in this difference between Fox News and MSNBC that shows out, in part because this is coverage that spans the period from 2015 to 2020. So there's a lot more that I could say here, but for the interest of time, I'll simply say that a lot of the evidence in the book points to this idea that stock markets are very heavily described in news media. And it goes beyond just the simple content analysis to also think about the ways in which Americans are so incidentally exposed to stock market news. I'm sure at least some of you have gotten push notifications on your phone about the stock market in the last couple of weeks. I'm sure that you walked by a building with a stock ticker running. This is from Times Square, so maybe you're not walking by Times Square every day. But many, if you're downtown in Baltimore, there's a stock ticker that's running on a building that's just off of Light Street. Maybe you've turned on cable news and you've seen the scrolling marquee, the ticker that happens to almost always grace the bottom of these networks because of the flashiness, right, of the marquee. And then maybe you've been in an airport lobby or hotel lobby, or you've gotten breakfast at like a Holiday Inn Express or something, and you've been inundated with stock market news because they've changed the channel to CNBC or something, maybe a gym. I've noticed that a lot of gyms put CNBC on in part because they perceive it as being the neutral option compared to MSNBC, Fox, and CNN. So a lot of incidental exposure out there for individuals as well, meaning that Americans simply see the stock market around them, news about the stock market around them, even if they're not seeking it out. And so at this point, I want to get back into the question of our hopeless, intractable biases. Here's a New Yorker cartoon from a while back where this guy says, "Do you have any nonpartisan pillows?" Which does maybe speak to kind of the state of things at the present moment. Right. One aspect of this book and of the broader framework of economic voting is this very strong critique of the previous literature that partisan motivated reasoning is going to sort of always prevail. I mean, that we're always going to believe things different about the economy, depending upon if we are Republicans or Democrats. And especially we might blame out-party presidents for bad news, right, more readily than if the in-party president were presiding, as I mentioned earlier. Right, which, this is a most recent kind of Pew Research Center depiction of these partisan gaps in people's beliefs about the economy. We can see here, right, during the Trump administration, reliably, Republicans became far more positive about the overall economy than Democrats. Democrats kind of really went south here towards the end, obviously, of during the COVID era. In the rebound of the COVID era, during the Biden years, Democrats became a little warmer towards the economy than Republicans, who were very negative. Right, in 2023, only 10% of Republicans said that the economy was excellent or good. So there's a reliable. I could do this graph back for quite a while, and we would see very large gaps emerging across partisan lines that switch over when Democrats and Republicans take office. So according to scholar Martin Bisgard of Aarhus University, right, bias will always find a way. But bias exists in degrees, is my argument. And some economic beliefs are more prone to this kind of bias than others, right? Because of the hypersaturation of the stock market coverage in media. Essentially, this is a very large table that I'll summarize very briefly. With 187 different unique survey items from 1980 to 2018, I was able to aggregate Republican and Democratic perceptions of a variety of different economic indicators, as well as the overall economy. And we can see that essentially among these different topics, the topic with overall the least sort of average partisan disagreement was essentially the stock market. So if we look, for example, during the Clinton years, there was really almost no appreciable difference between Republicans and Democrats in their beliefs about the stock market. The George W. Bush administration saw a slightly larger gap emerge of about 20 percentage points overall. In the Obama administration, in part due to the effects of the Great Recession, right, this contracted to about a 4 percentage point difference in absolute terms. And in the Trump administration, there's been a 17 percentage point difference. If we look across some of these other indicators, so like unemployment, those gaps are much larger on average. And so aggregating this all together, and I told you I'd get back to eggs. There's a story here about how perceptions of some aspects of the economy, like unemployment, overall perceptions, are simply much more biased than others. So interestingly, prices is also a topic for which there was relatively less bias. But the lowest kind of all is the stock market across this 187 different surveys that I analyzed in the study. Just a brief note on prices, right? I think prices also are going to fall into this less biased kind of category. And one of the reasons why we might have seen prices become so become such an important sort of determinant of Americans' political attitudes in the 2024 election. I think is in part because, again, prices are something that can be aggregated a lot more frequently and reported in the news a lot more frequently than some of these other things that rely on quarterly or monthly data distributions to track. So prices and markets, for the same sort of reason of convenience for journalists, might become something that's more ubiquitous in coverage, leading to less overall partisan bias there as well. Kind of the broadest takeaway here, the end of the journey is really about this graphic in terms of evidence supporting the claims that I want to make today. And this is ultimately a sort of sophisticated regression model where I've got a whole bunch of surveys capturing presidential approval baked into this model. In fact, it's about 3,700 and change weekly tracking surveys of presidential approval, looking across several decades from the 1990s to the 2020s. I control for a wide variety of other economic information. And I look here at the effects of the Wilshire 5000 index, which is basically just the whole stock market. It's an indicator of the stock market writ large. What we can see from this graphic is that the accuracy relatively of Americans' judgments of the stock market, the ability of the stock market to pierce through Americans' bias lenses, means that over time, from the 1990s, where this relationship was pretty much zero, to the 2000s, where it became more positive, to the 2010s, where it became even more positive, and actually the 2020s, where now there's an appreciable 2-3 percentage point difference in overall presidential approval from week to week. According to the stock shares, right? There's now a very positive correlation, essentially, between people's attitudes towards the market, or the market's objective movement, that is, and people's attitudes towards the incumbent president. And so the stock market, according to this analysis, has become beyond partisan motivated reasoning, beyond some of the other screens, perceptual screens that might challenge the ability of Americans to do economic voting that scholars in the 2010s were so worried about. It seems like this is able to pierce through that veil and ultimately continue to have a tangible, appreciable effect on the way that Americans appraise their political leaders. And again, that is while keeping all of these other aspects of the economy held constant. So it has a unique and independent effect on these attitudes relative to other economic data. So, right, despite our biases, I'm not sure what happened to the text on this slide. This is what happens when you put a talk together in like 3 days. But despite our biases, right, the saturation of the stock market news, right, might mean that economic voting is still possible, but it's shaped by this peculiar indicator relative to others. Here's Trump with his tariff list that is by now a famous image, right, with all of these reciprocal tariffs being levied on countries and also economic unions, and then also countries within those economic unions. And so I'll conclude by simply talking about kind of the last stop for partisan bias and the last threat to effective retrospective voting that we might think about. And that is the idea that bias can find a way, as I mentioned earlier, according to Martin Biscard, that people could still have biased perceptions of this economic situation, in part because they can seek to blame people other than Trump or Trump for the economic conditions of the day, using their motivated reasoning skills. So the idea here being that if Republicans agree that the stock market is bad, they could simply find a way to blame somebody else for those conditions than Donald Trump. What I think is unique about the present moment is the degree to which Donald Trump has claimed credit for the exact developments that have led to this outcome. And so, again, we do not know what is coming. We don't know what is going to happen at the present moment. But I will say that from the perspective of the partisan motivated reasoning literature, it's becoming increasingly challenging for almost any partisans. And I say almost any partisans because there are partisans that are committed enough that they will find a way to explain away these events, right? But it will become very, very difficult for many partisans to be able to explain away the link between market outcomes, which everyone knows about, which are very hard to frame, as other parts of the book argue, and Trump's responsibility. So I would conclude by saying, right, if an elephant does happen to meet a bear in 2025, it's going to be really hard for the Republicans to avoid picking up the blame for those developments, especially because there's been no real messaging strategy to avoid or to escape culpability for those developments. And so the stock market is very hard to frame. It's very hard to convince people that it is better or worse than it really is. And it's also, in this context, very hard to convince people that it is not down to the president as a source of some of these economic anxieties. So if an elephant does meet a bear in 2025, my prognostication, right, is that this is going to have an outsized impact on congressional elections, in part because we know from much prior literature that many Americans go to the ballot box in midterm elections with the performance of the president as a foremost consideration in their willingness to support Republicans, Democrats. One of the big reasons why we tend to see presidents who take office with sweeping mandates in 1 year end up having a retrenchment of their party control in Congress in the 2 years prior or following their inauguration. So again, nothing is certain. Volatility is the name of the game, but I hope that you all will continue to keep an eye on the stock market and also think about the potential for political ramifications for those developments. The mixed feelings that we might have about whether it is meritorious for Americans to connect those two things together, but also to keep in mind that the attribution of responsibility here seems to be much more clear than in other cases. So again, thanks so much for listening to this, and hopefully this has stimulated your thinking about the economy, the market, and the present moment. Thanks.
Great. Well, thank you so much, Dr. Anson. I really enjoyed the talk and definitely enjoyed the book. As a housekeeping note, in a few minutes, we'll drop in the chat all the people who have won the book. Certainly, it's a fantastic read, and you really preempted the question that I was going to ask, and we'll open it up. Of course, I was going to ask you to speculate on the midterm elections, which you've already done. I will ask, though, why are we thinking about this connection now, right? Of course, the stock market's not new. It has been around since at least the 17th century when we think about various exchanges. I mean, even Planet Money, right? The segment on NPR has been around since 2008. So, why are we thinking about this kind of connection between the stock market now and some of the political implications today?
Yeah, that's a fantastic question. And there's only so much that the book itself can get into history kind of before the 1980s. But our economy has also changed a lot, right, in the last several decades. We're a more modernized economy than previously, and so that is also part of the story. Is that, and I would argue that in the 1950s, the stock market was obviously still important for the economy, was still important for people's livelihoods. But people, were also not as tuned in to a 24/7 media ecosystem as well. So it's tandem developments in our economy, moving from a more industrial economy where some of those kinds of indicators would be more important for people, to also now, in addition to a financialized economy, a 24/7 attention economy, where biases in the information environment, biases in the degree to which things are saturating our media coverage of the economy, those things can become sort of more pronounced simply because we have so much more availability of news. So, in the 1970s or whatever, when I could turn on the news at 5 or 5:30, see a 30-minute broadcast of the rundown of daily events, I could be hit with a stock market story once. If I'm checking my phone every 40 minutes and seeing push notifications or a scrolling news feed, the imbalance is going to compound. So I think that's part of the story. Certainly not all of the story. And I would be interested to hear if anybody else in the chat can help me speculate as to the long-term development here. But I think it's fair to say that Americans tend to think and talk about the stock market a lot in the present moment, and not just because of the developments since COVID and the GameStop kind of fiasco that led so many people to kind of glue their eyes to the roller coaster.
Yeah.
Yeah.
Yeah, thank you. And Dumb Money is definitely worth checking out. So I think I saw Jason first and then David.
Hey man, great talk. So, should I invest in tulips? What do you think? Is this a good
Ooh,
time?
yeah.
Put it all into
That's
tulips.
a tough one. I'm not qualified to give any financial advice. I want to make sure you do your due diligence. That's my only
Tulips it
my
is.
only recommendation.
Tulips it is. Thank you. I so if what you say is true, and it I am persuaded that what you say is true, then how come Biden had subterranean approval ratings, just dismally disliked after 23 and 24 when it was just like meteoric rise in all the stocks. I mean, money was just faster than you could take it out. You didn't have to be smart. It was so this seems like the most recent example is also the most poignant counterpoint to everything else you said, which again I find persuasive. So what other than high prices, uh, or is that it? Like, what explains that?
Yeah, that's a fantastic question. I too have sort of struggled with this for the book because obviously the book was 2023 and we didn't really see this take off until just a little bit later. And in fact, I think the proofs was 2022. But no, I do think that the broader kind of theoretical mechanism of media hyperattention can tell a story about an inflationary era, captivating the minds of people even more so. Because I mean, the stock market isn't special. I think is kind of the argument here. It's really about the agenda setting power of the media to get us to focus on certain elements of the economy relative to others. I think if you look at the earlier part of the talk, where I was saying like, look, people should care about the stock market for various reasons, but there's a lot of reasons to argue that they shouldn't, right? And I do think that in an era of high inflation, which is something that really was not quite captured in this data set, that may be a very, very powerful source of political judgments that has kind of gone ignored since the late 1970s. I know many of you recall the era of sort of stagflation and just the amount of panic and chaos that caused. I mean, honestly, like the entire social climate of the 1970s was also like the vibes were off, and in part because of the economic situation due to rising prices without wages. And so I think that there is a story to be told about media fixation on specific market goods. Everyone jokes about eggs, but it is true that those were extraordinarily saturated kind of narratives in media at that time. And so, yeah, I mean, I think the stock market was not something that Americans forgot about. And in fact, many people on the left tried to use this, to some extent unsuccessfully, as kind of a rallying cry around the Biden administration. But there's another thing that, the sort of grain of salt that I want to cast is that, this is not to say that these are one-to-one relationships, right? There's a lot in politics that happens outside of the movement of the markets or the movement of commodity prices or CPI or wages, right? There are foreign policy decisions. There are decisions about the broader political landscape and about what to do, let's say, with the aftermath of Trump won, right? That might have created a lot of ire, even among would-be supporters of Biden. So it is a complicated picture, but yeah, I do think that I do take very seriously the idea that Biden's roaring stock market is not really well accounted for in this account. But then again, maybe it's something that was not very well accounted for by the news media of the day.
And next up, we have David.
Yeah, okay, yeah. Thank you, Ian. Thank you for the book and congratulations on the book and the project. One issue, well, there's two issues I wanted to raise. One is you didn't say anything about the bond market, and arguably both presidents are more sensitive to the bond market than they are to the stock market. Arguably, well, actually, not just arguably, it seems that one of Trump's recent flips on tariffs had more to do with bond market trends than the stock market. But arguably, there's more of a connection between what presidents and Congress does and so on, and bond market moves than there is with the stock market. Because there can be other things affecting bond markets, but arguably that's more directly tied to federal monetary and fiscal policy than the stock market is. So I'm just wondering about bringing the bond market into the analysis. The other issue I want to raise is sort of some of the longer term trends that Thomas Piketty and others have pointed out in terms of sort of shifts in the structure of the electorate regarding education and wealth, where it used to be the case that the more educated and the wealthier tended to be Republicans. There's been this sort of reversal where, over the last decade or so, it's really been the less educated and the less wealthy that are becoming more Republican. And I'm just wondering, and then which would seem to go a little bit against the grain. You sort of acknowledge this about the role of the stock market insofar as it's been this kind of reversal in wealth education gradients. So those are the issues I kind of wanted to put on the table.
Yeah, no, those are both fantastic observations. And I definitely agree with you that the bond market is incredibly important and incredibly important for policy. We're seeing this week that we don't, I guess I would say, in response to your comments about the bond market, it's not always a great thing when we're talking about the bond market, right? That's usually signs of some pretty gnarly instability. We talked about the bond market during the Great Recession a lot. So, if we were to look at the graph across time of when the news media start focusing on the bond market, I think it's definitely again, not a very promising indicator of coming attractions. Then again, right, it's probably not something that's as saturated in long-term coverage. And so kind of one of the arguments that I make is that people get habituated to hearing about certain things. I don't know that Americans have as much of an understanding of what the bond market is or what purpose it serves, other than my retirement portfolio has some amount of it over time. And so again, like I looked at this topic within the larger set of topics that I mind in the news media, and the bond market is not talked about maybe as much as it should be. But I think that's part of why it's maybe important for presidents, but not as important for the public, because the public is kind of not as inundated with information about it on a week-to-week or month-to-month basis. But I really like this mention of the Piketty stuff and about the switching of the two parties' coalitions. We're seeing this kind of just really start to materialize for real in the 2024 electorate. This reshaping of the two coalitions into especially education being a very strong now predictor of partisan affiliation. And yeah, about the Democratic Party potentially being a party of more investors than of Republicans in the future, in part because Republicans very consistently have rated the stock market as being more important for the broader economy. They tend to value it as a valuable indicator for their own well-being more than Democrats. And so the policy implications of that switch, I mean, are large. I can't quite even imagine what that might be. But it is, in terms of like people's exposure to information, I think people are still going to, regardless of their party affiliation, going to pick up that information. I think it just depends on how relevant it is to their own personal well-being, which is something that might be shifting, maybe even strongly in the next cycle. So yeah, I think those are both very important observations.
Great. And we have Susan next, and then Smitha.
Thank you so much, and thank you for your patience with me. I have a new computer, and so I just don't really trust the interface, is the short story. It doesn't always look the same. Thanks so much. Thank you, Ian, for just a terrific talk and really interesting and important and really rich and just completely impressionistically to David's point. Complete impressions, but it does feel like when we hear a mention of the bond market, there's a whole lot more explanation around it, right? Like it's not only more rare, but like, why do you care about the bond market again? Which this, you know, it goes to your point. But at any rate, that's not what I was going to ask about. I'm going both to your speculative point, but I'm going to try and make it an institutional point too, so it's not just speculative. You were noting that there's no explaining away the president's accountability on this one. There's been no messaging to try not to hold him responsible. But I wonder whether on the stock market, but I wonder and don't know whether that's where we would want to go to something of an institutional explanation where Congress is no longer a center of power. The parties are, right? So the Republican Party in Congress is doing what is lined up with the Republican Party as the president kind of thing. It's not a separate source of power, which of course was not what was envisioned in the Federalist Papers or lots of other things. Because so much else, and again, I so appreciate the cleanliness of your research design. It's really great. And again, really important and interesting. But of course, 1,000 things start popping to mind for me about what else has been explained away, right? Which I won't bother going into because we all know, as you didn't actually see what you saw, or it wasn't the president's responsibility, one or the other. And that Congress has been really happy to go along with that, or the Republican Party in Congress. And so that when there's a majority there, it's very difficult to get any toehold. So I'll leave it at that.
Yeah, this is an important point. I'm really grateful to you for bringing in an institutional perspective, right? Because that is something that in political science, we tend to be on opposite sides of a divide, maybe an artificial divide between institutionalists and behavioralists. To the point of signaling and messaging from Republican Party members and elites about explaining away basically Trump's responsibility for tariff actions influencing the stock market. There's an interesting line of research and something that I'm working on with a co-author, John Kane, who's at New York University. We're working on better understanding partisan motivated reasoning as a matter of degrees and just as a binary, right? Either you do partisan motivated reasoning or you don't. And so we're starting to study this idea of sort of extreme partisan bias or blatant partisan bias, where there's individuals who don't even really need like cogent explanations for why something is or is not the responsibility of an individual. They essentially would argue that there is nothing that an incumbent can do that would shake their confidence or their support for that incumbent. See that maybe even some of the members of Congress are exemplars of that specific strategy or that rationalizing sort of psychological motivation. But yeah, there's the work that we're doing in terms of the understanding blatant bias, who does it and why, is still in pretty early stages. But yeah, I do want to also bring a caveat to the table here, which is that people's attitudes toward the stock market tend to be fairly accurate relative to other things, but there will always be a set of partisans for whom there is truly nothing that you can tell them that will disabuse them of their loyalty to a specific partisan candidate or incumbent. So yeah, it doesn't maybe quite answer your question, but I think we need to remember that that's a subset of who we're talking about.
Scary proposition, particularly when we're talking about the institution that might serve as a check. Okay, off to Smita. And again, thank you everyone for joining. I know we're close to the 1 o'clock hour, so thank you. And Smita.
Hi, can you hear me?
Yes.
Hi, Dr. Anson. Thank you so much for this presentation. I found it really insightful, and I really like the visuals you provided on who owns assets and who has pensions, and breaking this down by race and socioeconomic groups, because it really showed me who's impacted and in what ways. I'm curious if you found anything of how generations react to the stock market. So in my personal life, I know Gen Zs are in tune to the stock market based on apps like Robinhood, or taking stock market advice from TikTok, or in the case of the GameStop investment. So I'm curious if you thought about Gen Z's reactions to the stock market and their voting patterns differing or contrasting from older generations who I would say have had more years of being in tune to the stock market. Or I would say like there could be a generational difference in financial literacy and accessing that financial literacy, and thereby potentially affecting how they react to the stock market in the political scheme.
This is a fantastic question, and yeah, I would love to be able to do more research on the attitudes of Gen Z specifically, because we have seen this real shift in the media environment surrounding, like Robinhood, for example, surrounding these meme stocks, surrounding crypto as well, right? Cryptocurrency investments being a very popular source of banter, source of entertainment in some ways, especially for younger people, and also the kind of get rich quick aspects of it. I worry that some of that is tied to that lack of financial literacy. I think there's a lot of people out there who would caution younger people from getting too involved in picking stocks or in investing heavily in crypto with the assets that they've accumulated, because of the threat of, these are not heavily regulated securities or anything like that. So rug pulls are common, and you can lose a lot of money very quickly. So yeah, I think that the conjunction of the social media entertainment sphere and markets and market forces is a really interesting sort of communications topic to investigate in the future. My study can't really crack into that at the present moment, but I would love to be able to study that going forward. So maybe you should send me an email or something. Maybe you've got some time left to do some research. We should work on it together.
Thank you.
Great. Well, again, thank all of you for joining us today. And thank you, Dr. Anson, for your wonderful presentation. It could be the case that President Trump read the book. He's creating a bear market now just to manipulate it later to be a bull market. So hopefully that's not the case. But again, thank you all for being here. And just congrats to Dr. Anson for the talk and certainly for the book.
Thanks so much, everyone. It was really awesome to have your attendance, and I'm really grateful to CS3, Political Science, and everybody who supported me. Thanks.